The people who understand money better than almost anyone else on the planet just sold gold, not retail investors, not hedge fund tourists chasing a hot trade. Central banks, the same institutions that spent the last 4 years buying gold at a pace we have never seen in recorded history. They just became net sellers for the first time since 2010. And here is what nobody is telling you about that. It is not the selling itself that should scare you. It is what they are buying instead. Let me explain what I mean. And stay with me here, because by the end of this, you will have a framework for understanding what is happening in the global monetary system right now that most people, including a lot of professionals, simply do not have. I have spent the better part of 5 decades studying how money works across history, across different countries, across different empires. I have seen this pattern before, not this exact moment, but this shape. And when you have seen the shape enough times, you recognize it even when the details are different. So let us start with what actually happened, because the headlines got this badly wrong. For 4 straight years, central banks bought over 1,000 tons of gold per year. That is double the pace of the decade before. They were not doing it because gold is shiny. They were doing it because they were quietly losing confidence in the dollar-based monetary system that has run the world since 1944. They were diversifying away from U.S. Treasury bonds, the asset that every central bank in the world has, traditionally treated as the safest place to park national wealth, and gold, which has no counterparty risk, which cannot be frozen by a foreign government, which has held value across 5,000 years of human civilization. Gold was the logical alternative. I watched this shift happen in real time. And I want to be honest with you, it was one of the more alarming things I have observed in my career, because when the people responsible for managing the monetary reserves of sovereign nations start quietly moving out of the thing the system runs on, that is not a casual portfolio adjustment. That is a statement about trust. And trust, once it starts to erode, does not usually stop on its own. So why are they selling now? The first thing you have to understand is that central bank gold sales and central bank gold purchases are not opposites. They are not 2 sides of the same coin. They tell very different stories. When a central bank buys gold, it is usually because they want a store of value that exists outside the system. And when a central bank sells gold, it is almost always because they need liquidity. They need cash. And the reason they need cash right now is deeply connected to what is happening with the global debt cycle, which is the thing I want to spend most of our time on today. Here is the framework I want you to hold in your mind. Think of the global economy as a machine. It is a complicated machine, but it runs on a relatively simple set of mechanics. The most important of those mechanics is debt. Debt is just borrowing from your future self. And when you borrow, you pull forward spending. That feels good. The economy grows. Asset prices rise. People get wealthier on paper, but debt is not free. Every dollar borrowed is a dollar that eventually has to be paid back with interest. And the more debt you accumulate, the more of your future income goes to servicing that debt instead of creating new growth. At some point, the machine starts to break down. We are at one of those points right now, not just in the United States, but across virtually every major economy on the planet. And the decisions being made in central bank boardrooms in response to this, the gold selling, the currency shifts, the quiet restructuring of reserve portfolios. Those decisions are the tremors that show up before the earthquake. Most people do not feel them. They are too small, too technical, too abstract. But I have learned over many decades that if you want to understand where markets are going, you do not watch the markets. You watch the plumbing. You watch the pipes through which money flows. Right now, the pipes are changing. Let me give you a concrete example of what I mean. The United States government currently spends more money servicing its national debt, paying interest, than it spends on its entire military. Think about that for a moment. Every aircraft carrier, every base in every country, every soldier, every jet, all of that combined costs less than the interest payments on the national debt. And that number is growing fast because interest rates went up aggressively over the last few years. And the U.S. government has trillions of dollars in short-term debt that needs to be rolled over at these new higher rates. The math is genuinely frightening. Now, what does this have to do with central banks selling gold? Everything. Because when a country gets into serious fiscal stress, when the debt burden becomes so large that normal policy options start to disappear, governments have historically done one of three things. They raise taxes, they cut spending, or they inflate. They let inflation run hot, which slowly erodes the real value of the debt. Every investor who holds dollar-denominated assets, including gold priced in dollars, has to factor this in. And the central banks that are selling gold right now are, in many cases, selling it because they see a more immediate problem. Their own currencies are weakening against the dollar. Their reserves are being depleted to defend exchange rates. And gold is the most liquid, most universally accepted asset they have. They are not selling because they stopped believing in gold. They are selling because they are in trouble. This distinction is critical, and I want to make sure it lands. There is a difference between selling gold because you think it is overvalued and selling gold because you need dollars to survive a currency crisis. One is a macro call, the other is desperation. And what we are seeing right now, particularly in some emerging market economies, is closer to the second. When you understand that the selling does not reduce the long-term case for gold at all, it actually reinforces it because it tells you that the underlying stresses in the global monetary system are real. They are intensifying, and the central banks that are not in crisis are still buying. If you are finding this useful, please subscribe. I put out these frameworks because I genuinely believe that financial literacy is one of the most important things a person can develop, and most people were never taught how any of this works. Neither was I at first. I had to learn it the hard way, building Bridgewater from scratch, making mistakes, studying history. The goal here is to compress some of what I have learned into something you can actually use. Now, let us go deeper on the dollar, because this is where the story gets complicated, and complex things, I have always found, are best understood through simple analogies first. So think of the US dollar this way. Imagine there is a town, and in the middle of the town there is a bank. Everybody in town uses this bank. They keep their savings there, they settle their debts through it, and the whole town's economy runs on the currency this bank issues. Now imagine the bank starts printing more of that currency to pay its own bills. At first, nobody notices. There is still only one bank. So what choice does anyone have? But over time, people start to notice that their savings are buying less. And slowly, very slowly, at first, then all at once, people start asking whether there is a better option. That is the dollar situation today. The dollar has been the world's reserve currency since Bretton Woods in 1944. Every country holds dollars. Every commodity is priced in dollars. International trade is settled in dollars. This has given the United States what the French finance minister in the 1960s called an exorbitant privilege, the ability to run deficits that no other country could run, to borrow at rates no other country could access, because the whole world has to hold your currency, whether they like it or not. But that privilege is being slowly eroded, not suddenly, not dramatically, but measurably. 3 out of 4 central banks surveyed this year said they expect the dollar's share of global reserves to be lower 5 years from now than it is today. 3 out of 4, and these are not idle opinions. These are the people actually making the decisions. When they say they expect the dollar's share to fall, what they are really saying is that they are going to make it fall because they are the ones holding the dollars. So here is the question you should be asking. If central banks are moving out of dollars and their gold selling is mostly driven by liquidity stress rather than conviction, what are they moving into? And the answer is more complicated and more interesting than most people realize. Some of it is going into gold. The structural buyers are still buying. Some of it is going into other currencies. Some of it is going into bilateral trade arrangements that bypass the dollar entirely. China and Russia trade in yuan and rubles. Gulf states are increasingly settling oil transactions in currencies other than the dollar. India is buying Russian crude and paying in rupees. None of these individually are large enough to dent the dollar's dominance, but taken together, they represent the early stages of what I call a paradigm shift, a fundamental reorganization of how the global monetary system works. Paradigm shifts do not happen overnight. They happen over decades. But when they happen, the people who understood them early are the ones who came out of it with their wealth intact. The people who did not are the ones who looked back and said, I knew something felt wrong, but I did not do anything about it. I want to pause here and be honest with you about something. Everything I am describing carries real uncertainty. I have been studying this for 50 years, and I still cannot tell you with precision when these trends will accelerate, how far they will go, or exactly what form the eventual adjustment will take. Anyone who tells you they know that is either lying or selling something. What I can tell you is that the direction of travel is clear, the historical precedents are well established, and the time to think about this is before the adjustment happens, not during it. By the time the crisis is obvious, the best positioning opportunities are gone. Let me give you one more framework that I think is essential for understanding this moment. I call it the big debt cycle, and it is the most important pattern in all of economic history. Here is how it works. Countries start out with little debt and strong productivity. They grow, their economy expands. They start borrowing because borrowing is cheap and the returns on investment are high. The debt builds for a long time. The growth generated by that borrowing is more than enough to service the debt. So everything feels fine. But eventually, the debt load gets so large that it starts to drag on growth. Interest payments crowd out investment. Tax revenues cannot keep up. And the government faces a choice default, which is catastrophic, austerity, which is politically impossible, or print money and inflate the debt away, which is the historical path of least resistance. Every major reserve currency empire in history has eventually taken this third path. The Roman Empire debased its coins. The British Empire printed pounds after World War II. The pattern is remarkably consistent, and it always has the same effects. The currency loses purchasing power. Savings held in that currency lose real value. Hard assets, land, commodities, things that exist outside the financial system go up in price, measured in the debased currency. Gold goes up, not because gold got better, but because the currency got worse. I am not saying the United States is about to collapse. I want to be very clear about that. The dollar's reserve status gives it a resilience that most currencies do not have. The U.S. economy is still the most productive in the world. The legal and institutional infrastructure here is still the envy of most of the planet. But resilience is not immunity. And the trends I am describing, the debt accumulation, the erosion of reserve currency status, the shifting global order, these are not things I'm speculating about. They are happening right now in real time, measured in official data that anyone can access. The central banks selling gold are telling us one thing. The ones still buying gold are telling us something else. And the fact that the survey of central bank intentions shows more institutions planning to buy gold than at any point in recorded history. 45% of central banks plan to add more gold in the next 12 months, tells us that the long-term structural demand is not going anywhere. The selling is tactical, the buying is strategic, and I have always believed that when there is a conflict between tactics and strategy, you should bet on strategy. So what does this mean for you as an investor? Let me give you a few principles that I have applied in my own portfolio and that I think are relevant here. The first principle is diversification across currencies and asset classes in a way that truly protects you if the monetary system changes. Most people think they are diversified because they own stocks and bonds and maybe some real estate. But if all of those assets are denominated in the same currency and that currency loses real value, you are not as protected as you think. You have diversified across asset types, but not across monetary systems. True diversification in this environment means having some exposure to assets that hold their value regardless of what any particular government or central bank decides to do. Gold has played that role for 5,000 years. I am not romanticizing it. Gold has long periods where it underperforms. It does not generate cash flows. It does not compound as a standalone investment. It is genuinely imperfect, but as an insurance policy against the failure of the monetary system as a store of value that exists outside any country's promises, it is uniquely effective. The question is not whether gold is a good investment. The question is whether the risks I have described are real enough that you should want some protection against them. And given what the central banks are actually doing, given the debt levels, given the dollar trends, I believe the answer is yes. The second principle is to pay attention to what the sophisticated institutional actors are doing over the long term, not what they are doing in any given quarter. The central banks selling gold right now are mostly selling for reasons of immediate liquidity need, not because they have changed their long-term view. The ones that are not in crisis are still buying. If you zoom out to the 5-year trend, the picture is unmistakably one of accumulation. Do not let quarterly noise distract you from the structural signal. The third principle, and this is one I feel strongly about, is that you should understand the mechanism behind any investment you make, not just the price history. A lot of people bought gold over the last few years because it was going up. That is the wrong reason. The right reason is that you understand why it might preserve its value over the next decade, given the monetary environment we are in. If you understand the mechanism, you can stay calm when the price drops. If you only understand the direction, you will panic at exactly the wrong time. That is how most retail investors lose money, not from being wrong about the direction, but from being right, but not patient. I also want to say something about risk that I think is underappreciated. The biggest risk right now is not that gold falls in price. Gold could fall significantly from current levels and still be a sensible long-term holding if the monetary dynamics I have described play out the way history suggests they will. The biggest risk is that you do nothing while your savings slowly lose purchasing power in an inflationary environment that the government cannot fully control without causing a debt crisis. That is a quieter risk. It does not feel like losing money, but it is. Let me take a step back and bring this together because I want to make sure I have given you something practical to take away, not just a collection of macro observations. Here is what the data is telling us. Central bank gold selling is real but driven largely by emergency liquidity needs, not by a change in conviction. Central bank gold buying is still happening at historically elevated levels among the institutions that are not in distress. The dollar's reserve share is expected to decline by 3 out of 4 central banks in the world. The U.S. debt situation is creating a structural pressure that the Federal Reserve cannot resolve without either raising rates to levels that would crash the economy or allowing inflation to run hot. The global monetary system is in the early stages of a multi-decade transition away from dollar dominance, and gold, along with a small number of other hard assets, is the historical beneficiary of that transition. None of this means you should sell everything and buy gold tomorrow. That would be the wrong takeaway. What it means is that if you currently hold 0 gold, you might want to ask yourself whether that makes sense given the environment we are in. Traditional portfolio theory has typically suggested somewhere between 5 and 15% in gold and other inflation-resistant assets. Given current conditions, I think being at the higher end of that range is reasonable, but the exact number depends on your personal situation, your time horizon, how much you need liquidity, and your own assessment of these risks. What I am giving you is a framework for thinking about it, not a prescription. I also want to be clear that I could be wrong about the timeline. The dollar's reserve currency status could persist for longer than the trends suggest. The U.S. government could find a political will to address the debt that it has not demonstrated recently. The global shift in monetary architecture could stall. These are real possibilities. I am not claiming certainty. What I am saying is that the cost of being positioned for these risks is low, and the cost of being unprepared if they materialize is high. That is the fundamental logic of insurance. And that is how I think about the gold position in my own portfolio. What I find myself coming back to after all of these decades of studying markets and economies is a relatively simple observation The things that hold value over very long periods of time are the things that human beings have consistently valued across many different monetary systems and many different civilizations: land, productive businesses, and gold. Not because of tradition or superstition, but because all three of those things have intrinsic properties that make them resistant to the dilution that eventually destroys paper currencies. A piece of land produces food. A good business produces cash flows. Gold cannot be printed. These are durable properties. And in a world where the pressures on the monetary system are as significant as they are today, durable properties matter more than usual. If any of this has been useful, please share this with someone you think would benefit from it. I genuinely believe that the gap between what financial professionals understand and what the average investor understands is one of the most consequential inequalities in the world. Not because markets are rigged, they are not, mostly, but because without the right frameworks, the right historical context, the right way of reading what institutions are actually doing, you are navigating in the dark. You do not have to be in the dark. The information is out there. The patterns are knowable. The history is written. The central banks that are selling gold right now are scared. That is what the selling tells you. And the central banks that are still buying gold despite the price, despite the noise, despite the quarterly drawdowns, they are telling you something too. They are telling you that the long game is not over, that the monetary system is still shifting, that the asset which has survived every empire, every currency collapse, every debt crisis in 5,000 years of human civilization, it is still the thing that the most sophisticated money managers on the planet want to hold when they are truly worried about what comes next. Pay attention to what they are doing, not to what they are saying. What they are doing is the signal. Everything else is noise.